It's policy day. The Monetary Policy Committee will announce its decision. Will it be another rate hike, a second consecutive one, or could there be a surprise thrown in? Let's put that question across to Manish Wadhawan of HSBC, who is joining us on Policy Morning. Manish, thanks so much for taking the time to speak to us. What's it looking like to you? Actually, more economists seem to be predicting a rate hike this time than they were last time. But, you know, things are unpredictable.
Morning, Ira. Yes, today is one of those policies where we are also splitting hairs that whether it is a hike or no hike. There are a lot of imponderables at this moment for the market to, think about. But I think I would like to dissect it in a manner that if we cut out the noise, the underlying data on economy, the underlying data on inflation, and the projected, the trajectory which is projected on inflation, I would actually go with a hike of 25 basis point, but with no stance change. And then they have all the time in the world to, take fresh calls from here onwards, how it pans out. So that's to start with.
Okay, Manish, so let's, sort of argue out both sides. The case for a hike would be that of course, we are an inflation targeting framework. We have to act ahead. We have to look at forward-looking inflation. But if you flip that argument around, people are saying that by the time this round of rate hike starts to impact the system, you'll already have seen core inflation come off peak, perhaps even headline inflation come off peak. How do you argue those two aspects out?
Sure. So starting, I think, on the argument for the sake of rate hike at this moment, if you look at the last 6 months of economic data and the June ending, even data on consumer sales, and if you look at tractor sales, if you like motor vehicles, across everywhere there's a lot of traction which is gaining ground. So economy is actually chugging quite well along. Secondly, on the inflation numbers also, with the MSP in place, though we really don't know how will they implement it in October to December or October to March. But if we put 2 and 2 together, there is definitely going to be something 40-50 basis points minimum adding to the inflation numbers. The core inflation momentum has been very, very strong in the last 3 months. It's going to continue for the next 3 to 4 months. What we are just talking about is that on the face of it, because of the base effect, you might see a deceleration in these numbers. But then you have to look beyond January to March. Again, the inflation numbers goes above 5%, and the average inflation for the year is approximately going to be 5.1 or 5.2, which is at least one quarter of a percent higher than the 4% target what they have. So in that context, and also I think I would not like to miss out on the FX part. I think RBI has had to intervene something like $30 billion in the last 6 months of the year to stem the tide on the rupee. If we put all these things together, then I think it would be the most ideal thing to hike the rate now and then go in a wait and watch mode for next 6 months and then take a call from January onwards. So this is pro rate hike. Yes, I would not deny what you said, that in the next few months the inflation is going to undershoot. It's going to be somewhere between 4.25 to 4.5 for next 2 to 3 months. Core also falls off to around 5.5% by December. Why should we take this step and let the recovery go? But I think I'm on the side of it'll be better to do a rate hike now, because we have to see in a medium term. It's not something that RBI is going to look at 2 months numbers. So I think these are the pros and cons.
What happens in the markets today, Manish, if you get a rate hike decision? Would we expect any sort of move on yields? Would it move? I don't think the stance is going to change. Would it move on the voting pattern then perhaps?
Yeah, if there is a rate hike, definitely it will impact the yields. Yields can go up, I would say, 5 to 10 basis points. We are quite evenly poised today. If you look at the short end of the curve is pricing in a rate hike. So that should not move actually much. Then comes the long end part of it, which definitely is a demand supply issue. I think the key thing which we'll have to see is what is the language they convey. I appreciate what you said, that they would not change the stance, or they might not change the stance. There is a full-fledged debate in the market that if they are doing 2 hikes, why should they not change the stance? But the answer to that, comes from what Fed has been doing at this moment. They have hiked rates from 0% to 1.75. Another one is coming. Still, the stance is accommodative. So from that point of view, we are in an uncertain world. What is going to happen? What call do they take on the trade wars which is happening? What happens on the currency? What is the call taken on currency? I think a lot of factors will determine today's decision. It's going to be a tough one. And I acknowledge, we are also as divided as I think could the policymakers be. But nonetheless to say there will be a reaction on interest rates, on the yields. If there is no hike, you might see a 5-7 basis point slide more down. But if there is a hike, you would see 5 to 10 basis points yields going higher also, maybe in a day or two.
All right. Manish, what's the expectation on commentary on liquidity? I think, they've been doing sporadic OMOs. The fact that yields have actually come down between last policy and this policy perhaps is testament that they're doing okay on the liquidity side, along with, of course, other aspects like public sector banks coming back and FI selling reducing.
Yeah, on liquidity, I still feel that they would not commit themselves on anything on OMOs. They would continue to state that we would keep liquidity in neutral at this moment, and we would conduct OMOs as and when required. I think what we need to understand is in the last 6 months, the liquidity conditions have definitely tightened in the banking system on account of two things. One is the currency, which has been expanding quite a lot in the last 1 year or so. And second thing is the RBI intervention in the FX markets, which in our estimate is around upward of $27-28 billion, including the forwards. They would definitely need to do more and more OMOs in the next 6 months to 1 year to keep even liquidity neutral. That is what I would consider. The market is hoping that they would have to do something like minimum of 1.2 trillion of OMOs this year, which is, I think, the most expected outcome. So don't expect any kind of a major change in liquidity. They will have to balance out what we are talking about. They will have to provide the primary liquidity through OMOs in a year where FX intervention is leading to outflows of dollars continuously.
All right, Manish, last question from me. I asked you this last time, I think, and I was completely wrong. But we are here still wondering whether we'd get to a point where the casting vote would be used for the first time. Do you think the MPC could be that evenly split?
No, I have my doubts about it. I think barring one vote, which I would say it would be, I think, everybody on one side, the way it looks like. And after last policy's minutes, it clearly is quite evident that they are building a consensus coming out. I don't think so that today also it would require the governor's casting vote or anything of that sort. So the split could be 4-5-1, but I think it will be more or less, the veto vote won't be required today also.
All right, Manish, thanks so much. Always good to talk to you, Head of Policy, to set us up perfectly. That's Manish Wadhawan of HSBC.